Hello, everyone. We are back today to take a brief snapshot on the macro and market events that has transpired during the month of November 2021. Coming to the equity market, Indian equity market fell in November in line with most other equity markets across the globe. Nifty fell 4% during the month. Small and mid cap posted a relatively lower decline than the large cap. Looking at the sector wise returns, most sectors were in red, barring a few defensives such as IT and healthcare and telecom because of the tariff hikes being taken by the companies. Basically, over the last few months, most markets were already overstretched, and also the liquidity has been moderating in the recent months. Against this backdrop, the development of new variant of coronavirus and that the fact that the Fed wants to accelerate its tapering worked as a catalyst to provide some pull-off from the equity market. VIX shot up. Even other asset classes such as commodities fell, rates fell, and DXY moved up. A lot about the Omicron variant will be clear in the coming weeks, but road has definitely become bumpier. Coming to the developments of this new variant, as we know things today, World Health Organization has declared this new variant of coronavirus, which was first found in South Africa, to be a variant of concern and named it as Omicron. The things that we know about this variant is that it has higher transmissibility than the other variants, but we do not have yet enough clarity on the risk that it pertains to morbidity, hospitalization, death, and how efficient it is. I mean, how the vaccines are efficient in protecting against this new variant. But we definitely know that due to the number and nature of the mutations of the spike protein in this variant, there is a concern that Omicron will reduce the protection provided by the existing vaccines. However, more on this will be only known with a greater clarity in the coming 2 to 3 weeks. But definitely, once again, markets and street have got concerned that there could be localized lockdowns, travel restrictions, and once again supply disruptions to the good trades, even labor mobility. And to that extent, it has already started to reverse some of the reopening trades that were getting played out. And at the same time, it also complicates once again the decision making for the policymakers as to what extent to support demand and to what extent get worried about the inflation. That is on Omicron. Now coming to the another development that concluded in the month of November, that is the COP26 conference in the Glasgow. Various developments happened with this regard. Firstly, three more nations, Thailand, Vietnam, and India, committed to the net zero emissions, while more countries pledged to adapt the changes required for the climate change purposes. Three important conclusions were made in this regard. First, there is a need to reduce the reliance on coal for energy generation. Secondly, governments have also been given an opportunity that there could be possibly trading of carbon credits. Thirdly, it was also decided that there is an urgent need for developed countries to scale up the finance that is available and the technology transfer for the developing nations. This is for a longer term good to prevent the global warming. But in the very near term, this transition could be inflationary. Plus, it will also crowd out the funding resources from other sectors towards these sectors which are working towards the preventing the global warming. Hence, in the near term, there could be volatility that we should be prepared of in many sectors. Coming to the Indian economy grew by 8.4% year on year in quarter 2 FY22. We have high frequency indicators available for October and November that suggest continued recovery as infections are coming down in India and mobility is stepping up. In fact, in the month of November, it were those contact intensive services which has posted a sharper recovery. Most high frequency indicators are suggesting a good growth even on a 2 year CAGR basis. Sequentially, consumer demand is improving, credit is picking up, import is also picking up. There is a pickup in the demand for residential real estate due to the fact that affordability has improved, mortgage rates have come down, and most of it is end user led demand. There is some bit of hiccups which is seen in the auto production and auto sales, both because of the semiconductor shortages and the fact that the two-wheeler sales is low in the rural area. Overall, we have yet not accounted for the potential economic impact of the Omicron, and we continue to stay at a 10%, near 10% projection of growth for FY22. But of course, if this Omicron variant intensifies, and once again there is an intensified mobility restriction, there could be an adverse impact to this growth projection. Another thing from a global front that we are worried about heading into 2022 is this growth slowing in China. China is the second largest economy in the world. The real estate sector continues to be in trouble over there, and the policy makers seem to be less inclined to do a massive easing or a policy support to that sector. And real estate sector accounts for nearly one fourth or even more of the growth over there. As such, if this second largest economy is moderating in growth, there could be potential knock-on effects to the other economies as well. Corporate earnings for Q2 FY22 concluded in India, and the broader narrative was that sales growth and profit growth were healthy. For most companies, the earnings outcome were either in line or marginally better than expected. There were two main narratives that came down from the management commentary. First, the demand is improving because of reducing restrictions and opening up of the economy. And second is the most commentaries indicated concern on cost inflation, not only because of the raw material and commodities, but also because of the labor, logistics, and other costs. But bottom line is that even at the end of November, if you will see, Street is mostly upgrading the earnings for estimates for most companies. In fact, amongst the BSE 500, 85% of the companies continue to see an upgrade. And Nifty estimates, earnings estimates still run to the north of 20% growth for both FY22 and FY23. That's on earnings, and we have always highlighted that earnings recovery is absolutely critical for this elevated valuations to sustain. And given that valuations are stretched on almost all parameters, bottom up stock picking holds more importance at the current juncture. Coming to the fixed income market, US Fed Chair Powell declared that it is time to retire the word transitory from describing inflation, and it also seemingly discounted the idea that the monetary policy should turn dovish because of the new variant of coronavirus. This makes the announcement uh, of faster than current tapering of $15 per month very likely from as soon as in December policy. In fact, market now has also started to expect the first rate hike commencing from as soon as in June 2022 versus their earlier expectation of somewhere in December 2022. And whenever historically the Fed has started to tighten the monetary policy, it has led to financial volatility in the emerging markets. And on most count, emerging markets are also finally led to taking the rates higher for their respective economies. Within India, policy normalization has already commenced in some form. First, by reducing or eliminating the outright bond purchases by RBI. Secondly, by scaling up the quantum of purchases done under VRRR. We are also in the camp that RBI needs to step up the policy normalization. It needs to normalize once again the LAF corridor, take the reverse repo higher. But as things stand today, and the fact that the Omicron variant had just been found out 2 weeks before the next monetary policy meeting in the first week of December, it, it is highly likely that RBI may stay put on the quantum of VRRR and also on the reverse repo decision. Though it may start to do a more of a VRRR purchases in the longer tenor, that is tenor beyond the 14-day auctions. Inflation pressures are rising in India. Even as the current prints for October and November are sub 5%, that is likely to go up to above 5% in the December outcome, and probably even to the 6% or higher level in quarter 1 2022. And to that extent, we have discussed a couple of times the several reasons which make a case for inflationary pressure to sustain. We think that the policy normalization should happen. With regards to the government finances, of late, there has been news flows that government might need to end the fiscal, central government particularly, might need to end the year with an expenditure which is higher than the budgeted amount. There are additional requirements which have come up on account of food and fertilizer subsidy, MG Narega requirement, and Air India liability. But yet, we think that the tax flows are so robust that on most likelihood, we may not see a material negative surprises from the government finances. And if at all there are higher expenditure requirement, they may get funded from the non-market resources rather than increasing the market borrowing. Another issue is market thinking about or market expectation about India's inclusion in the EM global bond indices. That is definitely a long term positive. But in the near term, it could most likely be a story of mid 2022. And that in the current environment, when fixed income market is cautious on fixed income, we don't know as yet what could be the entire quantum of flow immediately as India gets included in these indices. And against that, we also have to keep in mind that RBI is scaling back its purchases of government bond, and in FY22, if the credit environment picks up for the banks' participation in bond purchases could also reduce. Hence, to conclude, this is not really a very near term story to play with regards to Indian bonds. A word on valuation. Indian bond valuation, when compared to equity market or when compared to its own history or compared to its emerging markets, are broadly neutral. So technicals and valuations are broadly okay, but given the fact that we are worried about inflation moving up and policy normalizing, we are cautious on rates and we prefer GSEC over the other asset classes. That is broadly on the macro and markets. Signing off for this month. Take care.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.